navigating through. Jeb's got the listings lined up in a row. Josh brings the numbers, making dreams grow. First-time buyers stepping through the door. Keys to your castle, they're what we're here for. Navigating through the home buyer's maze. Educated steps in a world full of haze. The podcast is rolling with wisdom to share, helping you settle in your new land. Navigating through the home buyer's maze. Educated steps in a world full of haze. The podcast is rolling with wisdom to share, helping you settle in your new lair. Jeb and Josh, they're paving the way. Dreams to reality, they make it day. From the first hello to the closing sign, your journey to home is looking divine. Down, the numbers make sense. Jeb shows the vision beyond the white fence. Teamwork like this is rare to find, helping you leave all your doubts behind. They talk about homes and talk about life, cutting through the stress and the buyer's strife. With every word they light up the spark, guiding you through when the road feels dark. Jeb and Josh, they're paving the way. Dreams to reality, they make it day. From the first hello to the closing sign, your journey to home is looking divine.
Welcome, everybody. You will notice we are a man down this week. Mr. Jeb is in Arizona. He'll tell you all about it next week. He's doing a giant Grand Canyon hike, which is more fun than sitting here doing mortgages, although he may tell us that it wasn't that much fun, but it should be a good adventure. We're going to go through everything just like we do every week. I've got all of his slides, going to give you that info. We'll dig in and run through it. If you have questions, go ahead and get them posted now. We will jump to it when we get here shortly, but let's get these. Goodness gracious, what is the problem here? All right, there we go. We got them. So inventory, as we've seen, what are we going back to July, has been really flat, has not been increasing as it still does seasonally. So we saw the peak a little bit earlier, but it hasn't really dropped either. 16.24% more than last year. Saw data, we don't have the slide in here, but I saw data from Resi Club stating that there are 5 less metros this month that are showing decreasing prices. Not to be unexpected. When we get to interest rates, we're going to go through that and show you what that looks like. Let's go here. Jeb has the content here for Orange County. So Orange County, 2.69 less inventory, 2.69% less inventory week over week, 0.75 for Huntington. So from that perspective, we're actually seeing a little bit of a dip here, and you've seen that dip Orange County wide, so much more so than that flat level that we're seeing in most of the country. For new national single family new listings, again, just kind of trending sideways. We're on par with where we were in 2024, but above 2022 and 2023. So more new homes coming to the market, but really over the last 4 years, those charts have all looked pretty darn similar. In terms of weekly pending sales, basically right on track with where we were last year, 59,755 pending sales this last week. Saw some forecasts this week that we may see a slight uptick, assuming that rates stay lower in terms of the total sales for this year and definitely the forecast for next year. So percentage of properties with price reductions. I may have another chart in here. I wanted to throw this in here of just showing you what that looks like, bigger picture, but flat, seeing less price reductions, and we're back below 2022. 2022 was probably the worst year because many sellers who really, really wanted to sell when they saw interest rates shooting up were cutting prices to make sure they got their home sold. So slightly above 2025 or slightly above 2024 and well above 2023, but definitely flatlining here as rates have cooperated and made it a little bit more affordable for buyers. Wanted to throw in these numbers. So this is the 1 year change in home prices between September 24 and 2025. This throws in hot and cold all in one. We're going to split it out so you can kind of see how many of them are seeing negative prices and which are actually seeing price gains. So you can see, as usual, the Northeast and upper Midwest is where we're seeing the blue in terms of the Northeast actually has a lack of supply. Still, the upper Midwest has greater affordability than other places and didn't experience quite the price gains that some of the Southeast and Southwest did. So not to be unexpected there. So 1 year change, this is the hotter markets, which you can see there are strong markets everywhere throughout the country, even in Texas, as you'll see from there. But if we look at the downside markets, they are definitely along the southern border. And it's interesting here. You see two big, slightly pinkish flesh colored tone there in Southern California. And again, from my perspective, it's not what we're seeing. I deal primarily with first time buyers and entry level buyers, and not as much the people that are moving up and buying luxury $2 and $3 million homes. Maybe that's where we're seeing some of that weakness, because again, homes at or below the median price that are nice quality homes, there aren't a lot of them on the market. Plenty of homes in those price ranges, but not necessarily the turnkey ones that most buyers are wanting. So again, we talk about how important it is to follow the local markets and know what you're seeing there, and your mileage will vary depending on where you are. So we are still, 2.5, 3 weeks here into this government shutdown. We don't have a lot of data that we feed off of in the mortgage business. So I just did sort of a grab bag of some things that you guys are interested in that I wanted to go through and pull for you. So Parkle Labs runs this. This is they run these numbers showing acquisitions and dispositions, and then net holdings of institutional buyers. A lot of people, and in some markets, this is real. If you're in Georgia, if you're in Phoenix, there are a lot of institutional buyers of properties. For most of the country, it's not a big deal. And what we're looking at here and what we are seeing is that many of them are now net sellers. The gray bars show what they're purchasing, and the purple bars show what they are selling. Most of them, those purple bars, are much bigger than what we're seeing. So more dispositions, getting rid of more properties than what they are buying, even though they may still be buying. There's some rotation up possibly there. We talked about the withdrawals, properties getting pulled off of the market. So this is Compass data. And when we look at that, you can see it's definitely elevated, but it is tailing off. The last few years, we kind of see that pick up through the end of the year. It'll be interesting to see what this looks like when we get November and December data on here. And if you see that pickup of people taking their homes off of the market. A lot of times what happens, you get to the holidays, people are like, I don't want showings. I don't want people seeing my house. So you're probably going to see again, a leveling off here until we get to about the early part of November. And people say, if I haven't sold my home, I don't want it on the market during the holidays. This one shows you what's happening with below 3% and 3 to 4% mortgages outstanding. So we talk a lot about lock-in. There aren't as many homes available on the market as there otherwise would be, because the sellers are also buyers needing to move up and buy another property, and they don't want to give up their low interest rates. But we can see that continuing to thaw. At one point, we had almost 25% of mortgages below 3%, and that's down to about 20%. So some of those people refinanced, most of them sold and moved on to another property. That 3 to 3.99 was at 1.40% of the market, and it looks like we're about 32, 33%. So over time, that lock-in effect will moderate as the new normal comes into play and you see more of the higher interest rates. One way that buyers since 2019 have adjusted to higher prices and higher interest rates to combat low affordability is bigger down payments. So you can see in August of 2025, median down payment of $70,000. That's up 6% year over year. So when you look at that, that's a pretty hefty amount. I couldn't find it. I need to do a better job of bookmarking my notes and having the information together. But what I saw was this is actually moderated here according to someone else's data, has decreased a little bit. So definitely still elevated, but not quite as high as it was. This is from ADP. That is a report that I get every Wednesday. And what they were pointing out here is prior to COVID, 2017, 2018, 2019, we saw about 6.7 to 6.9% turnover. So people either getting fired, laid off, voluntarily leaving jobs. And that has trended down. We're at like 5.8%. So what it tells us is we're definitely seeing a transitioning labor market. Employers are not doing nearly as much hiring, but they're also not doing a lot of firing, not a lot of layoffs. So we just kind of have this low turnover market, and short of seeing something break, it's going to take something breaking, either in terms of the labor market or inflation coming down, to see rates move a ton lower from where we are. But we're just not seeing that yet in the data. So I wanted to throw this one in here. We talk a lot about, the 4 factors of home ownership. Now that the tax benefits, especially for entry-level buyers in more affordable markets, are fairly minimal under the current tax code. One of the 3 remaining big stools is leverage. So 0% down, other than VA and USDA buyers, that is not a reality for most people. But if you put 0 down, you have infinite leverage. So this uses an example of a $200,000 house. Not a whole lot of them left in the country, but if you found one, 5% down is $10,000. But you get 20x return. So if that house goes up 2% in a year, you're getting a 40% return after 1 year on your investment. So you just don't leverage many other investments. The average person doesn't. Many people do. High net worth individuals, people who are used to investing and wanting to use margin and leverage. But for most people, the common man, you and me, this is what leverage looks like. And it's one of the reasons why housing has been known as a wealth builder. So I thought this chart was interesting to show you guys. Here, looking at the bonds, the bond market continues to trade, even though we don't have a whole lot of data. And we've really just seen this slow grind lower, and we've been under 4% on the 10-year for the better part of a week. We're going to hit some resistance at that green line, which is about 3.92. If we get through there, you have maybe another 1/8% of improvement. So for me, when I look at this, my concern or my worry is that we've had a vacuum for data. We're going to get hit with a bunch of data in a relatively short period of time when the government reopens. It's not like the day the government reopens, those people hit their desks and all of their reports are available. We're going to get CPI. I think we get it tomorrow, if not Friday. It's delayed, but we're going to get CPI, and that could impact the market. If it's hotter than people expect, we could easily be back up within that green down channel there within a very short period of time, because it's not that far above us. It's about 401, 402. So rates would still be excellent, but you would see sort of a normalization into that down channel. So we'll want to watch that data when the government reopens and we get a flood of data coming in. We are absolutely going to want to take a look at it there and see how that impacts us. It could push rates lower, but if any of that stuff surprises to the high side, either jobs or inflation, you could see some give back here. So be cautious if you're looking at refinancing, if you're in escrow and needing to lock. This has been the best time in over a year. So if we look at this 10-year or 30-year fixed, 6.17. FHA 5.9, VA 5.9. Again, the most well-qualified borrowers are going to be able to do a little bit better than that. But if you have a lower credit score, not even a low credit score, 720, 740, you may end up being a little bit higher than that. If you're doing a minimum down 3%, 5%, and you don't fall under Home Ready or Home Possible, you're probably going to be a little bit higher than that. But this is a really good indication. And directionally, it's a very important guide, because you can see here, day over day, rates basically flat, but over the last week, almost 1/8% better. Over the last month, a little bit more than 1/8, a little bit less than 1/4. But over a year, we're seeing a big improvement in interest rates, over 0.5%. So when we look at that, we're in a very good spot from that perspective. So just a reminder here, all of the pinky red states there, those are states where our team can assist you. I'm licensed in about 10 of them. Other team members can cover all of the rest of them, and we will be a part of that process in helping you. So if you're looking at taking advantage of those interest rates, either through a refinance or getting pre-approved to purchase a home, we would love to talk to you. The crawl there at the bottom of the screen, jebsmith.net/start is the best place to go. You can input all of your information. Just ask 4 or 5 basic questions, what you're looking to do, purchase or refinance, and lets us get in contact with you and get you on my calendar. The rate watch, really, most of you, if you're thinking about this now, you probably have a rate higher than where we're at right now. So rather than the rate watch, just use jebsmith.net/start, and we can jump right into that. So let's go. We do have some questions here from you guys. We will jump into it. I'm here as long as you guys have questions. So anything that you have mortgage or real estate related, I will do my best to answer in Jeb's absence. If it's super in the weeds in terms of contracts or agency and that type of stuff, we're not going to be able to help. But in terms of buying, investing, all that stuff, let me know. Also, if you're here, jump in and show us or tell us where you are watching from. Always like to hear where you guys are at. So Drew is kind enough to pipe in and say that the AI generated intro song makes me laugh every time. I'm shocked that I haven't memorized all the lyrics yet, because it makes me laugh every time, because it's like it's the first time I've heard it. So then follows up with good evening. So appreciate you being here, Drew. Dixieland here every week. Thanks for the notification. Looking forward to another exciting and educational episode. So hopefully we don't disappoint you with that. Marcus Doswell follows up with thank you for all this great info, Josh. Hope the house hunting is going well for you, Marcus. So let's see what we have here. Let's start with Killswitch556. Says, wanted to ask a question before I forget. My credit union offers a first-time home buying program, 0 down and no PMI. Am I missing something, or do these offers exist? The important thing that you said is it's your credit union. Your credit union is making that loan with depositor funds, so they can make up their own rules. It doesn't exist in Fannie Freddie land. It doesn't exist for FHA. There are down payment assistance programs where you take a higher interest rate. We looked for one for a listener today. He was going to be under 6% if we did a standard FHA. And for the assistance, to get him the 3.5% down, it was going to put it just over 7%, 7 1/8, 7 1/4. So over 1% difference to get you those funds. But back to this specific question, there are a handful of credit unions that are portfolio lenders. They don't operate as a glorified broker like most credit unions do, but the bigger ones that make loans of their own funds, they can make up their own decision. So what we have to do is just do a side-by-side comparison and say, what does this look like? And it doesn't have to be better than the terms of a 3% down to be the right decision for you. It just has to be good terms, because we don't have anyone else offering a 0 down to a non-veteran, non-USDA buyer. So if that's what helps you get into the market and the numbers make sense, you're probably going to be paying an above market interest rate. But as you said here, no mortgage insurance. So the effective rate, the amount of money that you're paying for that loan can be reasonable. I've seen some of them and you look and you're like, that's ugly. Why would we do it? I've seen others where it's good, but it's not a trick. It's not a bait and switch. They absolutely do exist out there with some credit unions. You just got to look at them and see what the terms look like. So miscellaneous of the whatever says, hi, Josh, can you do a show on home equity line of credit, how it impacts credit score, pros, cons, what happens if house is later rented out? Let's just go through it right now. We don't have a ton of questions. So as we're waiting for some more to come in, let's just check it out. In terms of a home equity line of credit, how does it impact your credit score? It's going to be an inquiry in the short run. That will have a small impact. When you open up a new line of credit, any type of credit, revolving, installment, auto loan, student loan, it's going to have an impact on your credit. If you have good credit, it's a very minimal impact. The longer you have that, and once you show that you have a good payment history, it's not going to have a significant impact. It can actually improve because it's giving you a new type of credit, new depth of credit, new length of credit the longer you've had it. So short run, small negative, longer run should be a positive. The pros and cons, it really depends on what you're going to do with it. You know, I've seen borrowers take $100,000 home equity line of credit and they're like, hey, we got money for a vacation. Or say we have $100,000 and they need to pay for something and pay down a bunch of debt. It's not uncommon when someone goes, hey, this is awesome. We had $1,000 of payments outgoing and now we got $450. They fill that vacuum with new debt. So the biggest con is the potential and the access to this credit. So if you're not disciplined, if you're not able to stay focused and stay on top of it, you can absolutely get yourself into trouble with this additional debt. On the flip side, you can use that money to invest. I talked to a listener today that his thought was he was going to get an SBA loan. And he's like, SBA loan takes about 4 months. It's pretty expensive. HELOC it's not free, but close to free for well-qualified borrowers with really good credit. If you ever do a bank statement loan or other types of alternative qualifying, you're going to pay for that. But for most borrowers with really good credit, you can get it at a very low cost. So he was going to look at that of starting up a franchise business. You can, like we talked about, you could pay off higher interest rate debt. There's any number of things that you can do with it that are positives. In terms of what happens if the house is later rented out, I've never seen a home equity line of credit agreement that says that you're not allowed to rent out the property. All of them are individual and unique, so I'm sure it's possible, but I've never seen one from that perspective that limits your ability to later rent it out. It basically says you are using it as an owner-occupied residence. Now, the important thing is in those home equity line of credit agreements, oftentimes what you will see is it gives the lender large leeway to modify that to reduce the line of credit, change any number of things. So it's possible that if you change your mailing address and they determine that this is no longer owner-occupied, they could change the amount of credit available to you. So Marcus, this is a good question. How often do you see buyers using FHA versus conventional loans? I am of the opinion that there is no right answer. You'll see a lot of videos on YouTube, a lot of articles out on the internet. FHA is the greatest loan. Use it. FHA sucks. Never take an FHA loan. Those types of things. There's someone who has a really big YouTube channel in the mortgage space. She does a lot of loans. And until very, very recently, she would tell you that the FHA loan was the worst loan in the history of the world. And I say it's simply not true. And most importantly, numbers never lie. So what we do, if you saw this week's episode on the podcast, we talked about pre-approval 101. What should that look like? What should you expect? What are you going to provide? What are you going to get? And what do you walk away with? What is the benefit of a pre-approval and what should it look like? So as part of that process, for us, the final step prior to giving you a pre-approval letter or reaching out to your realtor and letting them know that you are pre-approved for X amount of purchase price is to go through that comparison. And I will put, if someone's doing a minimum down, 3% down, 5% down, they may say they only want conventional. I'm going to put the FHA loan option in there just for them to see. No one should ever tell you, hey, I think you should do FHA or you don't want to do FHA. They should show you. When you see it on paper, people will react differently. I've had 800 credit score borrowers look at a 3% down conventional and a 3.5% down FHA and absolutely conclude that the lower monthly payment on the FHA is well worth it relative to the cheaper mortgage insurance on a conventional loan. Conventional will have a slightly higher interest rate. Depending on your credit score, it could have higher or lower mortgage insurance. What it doesn't have is the upfront mortgage insurance premium of 1.75% of your loan amount that's added to the loan on an FHA. So how often do we see it? Conventional loans are done more commonly than FHA. But what I would have to say is, what does it look like a minimum down? I would almost say there's more 3.5% down FHA than there are 3% conventional. Unless someone has really, really good credit and 2 borrowers and is going to get low mortgage insurance, for most first-time buyers, doing a minimum down, the FHA tilts a little bit better. But if you're under 100% of the area median income or 80% of the area median income, you're going to be exempt from some of the loan level price adjustments, and it can lean conventional. So there is no rule of thumb. There's nothing that I can tell you guys here on the show while we're live that this is the right answer for you. We got to go through the numbers. We got to pencil it out. We got to present them to you, and beauty is in the eye of the beholder. You're going to look at it and you're going to know what's the right answer for you. So sort of a follow-up, similar question here. And actually you wrote it in here twice, and this one has more detail. Let's go with this one. How hard to refi from FHA to conventional? 800,000 at 6.692. Want to put more cash and get out of PMI. So this is largely going to come down to how much equity do we have in the property? If we did 3.5% down on the FHA and we added 1.75% on top of that, you had less than 2% equity. So to do the conventional, we need about 5% equity for the most part, since you're not going to be going Freddie Mac to Freddie Mac or Fannie Mae to Fannie Mae. You're going to have a hard time doing a 97 refi. You're going to need to do a 95. Assuming the equity is there, assuming you have a high credit score, you have a relatively high interest rate for an FHA. So again, I would always want to pencil it out and look at both options. It's the FHA streamline is super easy. We don't need an appraisal. The value of the property doesn't matter. Your documentation doesn't matter. We don't really need anything other than to show that you've made your mortgage payment on time for the last 12 months. So FHA Streamline super easy, but if you have high enough credit and you've built up a little bit of equity, it can definitely be worthwhile to take a look at the conventional. It'll have a higher interest rate, but at this point, with high credit score, should have lower mortgage insurance and can possibly make more sense for the long haul. So hopefully that answered your question. It's not hard at all. It's just going to require full income qualifying and getting an appraisal. So I'm not sure which of the slides David was reacting to, but he says he guesses he's living in an RV. My wife and I have been looking at millions of videos on YouTube to see if there's an RV, like a mid-size, maybe like a Super C that the two of us would like to cruise for a few summers. So get a used one, drive it for a couple of years, and then give it back, or sell it, I should say. These things are expensive. Really, really, really expensive. If you want to tell yourself that there are people way, way richer than you are or likely ever will be, look up some YouTube videos on an earth roamer. Earth roamers are about $1.3 million, and they're basically a giant F550 with a cool camper shell on the back. But someone did spend a lot of time, effort, energy building them out. So if you see Josh driving an earth roamer someday, you will know I've won the lottery, because that will be my first purchase. Mr. Tom Collins checks in and says, watching from my living room in SoCal. We absolutely appreciate that. Appreciate you being here every week and supporting. Aleutian Drones for a no-cost refinance. I've seen you mention the formula as $125K divided by your loan balance to determine when it makes sense. How much do you give back to the lender in that scenario? I'm not sure where you're going with how much do we give back to the lender. You don't really give anything back. There are costs. What are we saying? How much for a no-cost refinance? What are we paying in terms of a premium and an interest rate? It can depend on the loan type. So again, if we have an FHA Streamline or a VA IRRRL, the costs are less on those. We get a reduced processing fee. We don't need an appraisal. So the bigger the loan, and if you're looking at one of those reduced cost types of loans, it can be as little as 1/8% in interest rate. Sometimes with a smaller loan or an expensive loan, it could be 1/4%. So use that 1/8% in interest rate in terms of what you're not getting to the absolute rock bottom 0-point interest rate. And that will give you a good idea. So Aleutian Drones, hopefully that answers your question. So Cisco from Kearney says, brothers, what is up? We are one brother, only one brother today. Our other brother, as we said earlier in the show, is out hiking in the Grand Canyon. So let's wish him safety and pray for his safe return. It sounds crazy, but it is definitely, it's an early hike. He's going to take some video, so maybe he will bless us with some of that next week. Let's look at this one. Somebut469 says, can you guys help with a first-time buyer that wants to build a duplex as a primary residence? Unless you're a veteran, you are most likely looking FHA. FHA, there are FHA one-time close construction loans. They are few and far between. There are not a lot of lenders that do them. I always caution for a first-time buyer, building a property is, it's not a recipe for disaster, but there's definitely more potential potholes in the path there. Easy to have cost overruns, easy to have delays where you're paying interest on that loan, whether you're paying it out of pocket or it's just accruing on your loan. A lot of people will look at it and go, okay, I can cut corners here, and not cut corners in terms of not do something well, but I can save some money. I'm good at this. I can do that. Or I got a sweet piece of property. So every situation is unique. I know people do this successfully, but just be careful. So if you want, use that in the scroll there, jebsmith.net/start. Reach out. We'd love to talk to you about it, see if it makes sense. And if we can't help you directly, we can certainly point you in the right direction. Sabrina Santiago, that's the rare full name. We don't get a lot of full names here. It could be a nom de plume. It could be a pen name. Maybe that's her YouTube name, and it's not even Sabrina Santiago. But good evening, Josh. My husband and I are qualified for a conventional loan. We have excellent credit and no debt. Will we be able to have a lower interest or get the standard rate? First-time buyer. Lower interest, so excellent credit will have a better interest rate than worse credit. And it's all relative. So 780 is going to be better than 760, is going to be better than 740. So people with good credit, 720, 740, you'll pay a premium relative to that person with the perfect credit of a 785, 805 credit score. So there's nothing out there. It's almost like it's more you start at a baseline and we take it away with loan level price adjustments. So the more you put down, the higher your credit score is, the lower the interest rate is going to be. But with excellent credit, probably the bigger question there is a first-time buyer in New Jersey. New Jersey is a higher cost of living area. We want to look and see what the area median income looks like. If you're below 80%, you're going to get those loan level price adjustments waived. If you're below 100%, you'll get the loan level price adjustments waived. But under 80%, you'll also have reduced mortgage insurance if you're putting less than 20% down. So those are the things that we look at there. And it can be a little bit confusing in terms of understanding loan level price adjustments. We probably should go back and do another episode on it. We did it in 2023 when the FHFA during the Biden administration did change those significantly, because they're really sort of nonsensical right now. I had a loan that we closed last month for a listener to refinance, and the appraisal came in high. We thought we were going to be at like an 86% loan to value. Appraisal came in a little bit higher. It came in at 84%. We're like, oh, this is awesome. Lower loan to value, and those loan level price adjustments break off in tiers of 5%. So we're like, oh, we're going to be a lower tier. No, the lower tier actually had a higher loan level price adjustment because we went away from risk-based pricing under the Biden administration. They decided that the FHFA would try and a little bit of social justice, for lack of a better word, in terms of let's decrease the costs to people with lower down payments and lower credit scores and increase the cost to those with higher credit scores and bigger down payments. So people with better credit scores and bigger down payments are still going to get better terms, but the gap is much less than what it was. But at the same time, the part that I really object to is the craziness where a situation where having more equity in your home can result in a slightly more expensive loan than better credit or lower loan to value. So from that perspective, hopefully that answers your question. If we can help, use the link in the scroll there. Would love to talk to you about it. Our team can definitely help you there in New Jersey, even though we're on the other side of the country. So Cisco, should I pay points for VA if I plan on closing next year in March? I don't generally ever like paying points. I'll use the best example. Friend of the family, veteran with a service-connected disability, so he's funding fee exempt, bought a home here in early 2024. I think we closed in like March, somewhere around that time frame. In January, we were able to do an IRRRL because we did a 0-point loan on the purchase. We were able to do an IRRRL and get it down a little over 0.5%. And then rates here have dropped again. We just closed again last month at a little over 0.5%. So almost 1.25% lower in just writing that down. So unless you feel like these are the best rates that we're ever going to have, and we're never going to do an IRRRL, we're never going to roll down to a lower rate, I always feel like we lean more towards 0 points. We'll show you the numbers and pencil them out for you, but I like the idea of as few sunk costs in the loan as possible. So when the market cooperates and gives you that ability to roll down to a lower interest rate, that you're able to take advantage of it without feeling like, oh no, I already have all these sunk costs that I spent on those points to get the lower interest rate. So what do we got here? Marcus, you're dominating the questions here, but let's look. So when you provide an FHA approval, do you include the 1.75 MIP finance in the loan or paid out of pocket? Almost no one ever pays it out of pocket. What I would say is the times that we did pay it out of pocket was like during COVID. We were getting these monster premiums. So someone could take like a 0.25% higher interest rate and we would get almost that full 1.75 lender credit and buy it out for them. So now comparing between those two, if we get rid of the upfront mortgage insurance premium, the FHA has a lower interest rate. If you eliminate that UFMIP, we're just looking at the interest rate plus the monthly mortgage insurance. And for a lot of people, I don't say a lot of people, we just maybe for 2 or 3 borrowers, that made sense to go that route, but it is very, very rare that anyone pays it out of pocket. You're going to pay it at some point, one way or the other, right? If down the line you refinance to a conventional loan, it's going to be part of your loan balance. If you sell the house, it's going to be part of your loan balance. So I wouldn't necessarily object to someone wanting to pay it up front because it is what it is, but it just doesn't happen very often. So Marcus, we're just going to make it the Marcus show. We're just going to stick with Marcus here. Have you thought about making an updated video on the calculation of the front end versus back end debt to income for FHA and conventional? For those of you who are here and watching, if you have any ideas of shows that you would like Jeb and I to re-record, here's the reality. In mortgage and real estate, the majority of the audience is pretty transient, meaning that 3 months, 6 months, 12 months, they're paying attention because they're hyper focused on, I want to get a home. I want to educate myself. Then they get their home, they get their loan, and they move on. So for us, we can remake content fairly often. We're going on the 4th year of the show. We just did episode 130, 193, 194. So we're closing in on 200 episodes, which would be the end of our 4th year. So I'm biased. I think Jeb and I have gotten much better, but we started probably the first 20, 25 episodes are really like Mortgage 101. This is what you need to know to make yourself an educated buyer. But we're better at this. We've got feedback from you guys. We got 5 years of here doing the live show. So if you have any ideas or thoughts of what you want to see, Marcus has a great idea here. This is probably an episode that we will do in that Mortgage 101 bucket so you guys can see it and understand it. Marcus has educated himself and researched a lot, and he's asked some questions or pulled up some snips from either ChatGPT or Google that are just flat out wrong. So there's a lot of wrong answers on the internet that even smart people, if you don't know, this isn't your area of expertise. You just don't know. So if you guys have any ideas, throw that in there. But Marcus, I think that's a good idea. We should probably jump on that. So the Dungeon Dojo says, how do you handle real estate investors versus folks buying for their primary? Are there loans you recommend versus ones you don't? A lot of our investors right now, for whatever reason, over the last 2 months, I've had 3 different investors, people who own their own home, buying an investment property, buying duplexes. Duplexes, 3 units, 4 units, the cash flow makes more sense than single families. It's very hard to buy a single family without a big down payment and have it cash flow and make sense. So we've had a bunch of those, and those have all gone conventional. Those are very well qualified borrowers, high income, high credit scores, and it's really just a standard 25, 30, 35% down conventional loan. But I have a business owner right now that she has 2 properties and she wants to refinance one. And the only way to do it, because that tax return shows about $2 of income, is to go with the bank statements, which show about $100,000 of monthly income. So we know she's paying her bills. We know everything's good from that end. So really, you get into more of the debt service coverage ratio loans for people who the loans don't otherwise make sense. So that's primarily the difference there. And then also, if you want to roll renovation loans into a property, do you find there's an advantage on FHA versus conventional options? Again, now we're shifting from investors to a primary because the FHA has to be your primary. It can be later converted to an investment, but it really, again, the numbers never lie. We have those 2 numbers there. What does an FHA 203K look like? And then also, what does a home style renovation loan look like on the conventional side? Freddie Mac has one too. I forget what their name is. There's pros and cons. There's pros and cons to each, just like there's pros and cons to a standard FHA or VA purchase on that end. So don't really feel like there's an advantage one way or the other than running the numbers and you tell us. They have some differences in what they will allow for renovations. Like the conventional ones will allow you to put in a pool. FHA won't. A few different things there. So Nachami Village TV, pre-approved for $575 for a VA loan, 6% for a 30-year of the loan term. Should I ask for a better rate? I'm about to submit an offer for $525. Lastly, this is my second VA loan. What I would say is probably reach out. You can definitely do better than that on a 0 point. It's not going to be 5.5 on a 0 point loan, but you can absolutely do better than that. I forget here. Let's just for giggles here. Let's go back over here and go back to that slide. What is Mortgage News Daily? They have 5.91. So again, for someone well qualified, 575, maybe a little bit lower than that. 0 points would be reasonable. I like if it hasn't been offered to you, like the whole idea of arm wrestling the lender for something versus just checking. So I don't know if you're in a state where we can help. Vast majority of borrowers are, our listeners here, 80-85%. Use that scroll at the bottom, or you can reach out directly at info@theeducatedhomebuyer.com. Be more than happy to run numbers and show you what that would look like for you. But definitely 6% for someone with a 680 plus credit score in the current market, a little bit there on the high side. It's not egregious, but definitely $500,000 loan, 0.25%. It's real money. Danielle Clifton follows up with a very direct comment that living in an RV is even expensive right now. You got to find a place to park it. You got to move it around. You got to maintain it. Definitely not the cheapest thing, but better than some of the alternatives. So, follow up with you're currently in Georgia. We can absolutely help in Georgia. Our team does have, we are licensed to assist there in Georgia. So, if you'd like a second opinion, if you'd like some numbers on that, reach out. We'd be happy to go through that for you. So Dixieland is taking us completely off topic, which is fine because we're about 40 minutes into the show. We don't have many other questions right now. So if you have a question, you want to get it answered, throw it in here. This is a great time to get those questions, mortgage or real estate related. But Dixieland says, some say markets, gold is over 4,000 an ounce and silver is hovering around the $50 an ounce mark. It's interesting. It definitely looks like both are poised to go higher. Relating it back to mortgage and interest rates and where this goes, some of that is related to government borrowing. People are concerned of the government's ability to monetize their debt and devaluing actual dollars and inflation eating away at their value. So hard assets like gold and silver to the younger folks, crypto, primarily Bitcoin, maybe Ethereum, some of that stuff, also limited in its ability to be printed and holding its value a little bit better. So from that perspective, it all comes together and all comes back into play. We'll give it a couple minutes here for you guys. If we don't have a ton of questions, we can wrap it up here early for you. It's been a little bit of a slow market, not slow market in terms of volume of activity. With rates down, volume of activity, there's a lot of it, but slow in terms of data coming in, of being able to look at, to review and analyze, and to be able to tell you what's coming next. We had a 20-year bond auction today. It went fairly well in the absence of other data, which tells us that market participants, the data they're able to look at and what they're seeing is making them comfortable buying bonds in the current market, which generally leads us to think that yields will be moving lower. So definitely going to be something to bear in mind. Marcus back with another question. Let's go for it. Says, I know you don't like paying points for a rate buy down, but how often do you see buyers doing this and how much do they buy their rate down? Again, so we all have biases, right? One of my favorite things, in a past life 20 years ago, I was a level 1 CrossFit certified instructor, and in the 2-day course that they have you go through that, one of the very last things that we had was the instruction on how to do your programming for your classes. And Chuck Carswell, very good coach, he did a class basically on bias. If you are a big, strong guy, you're going to be biased towards lifting heavy. If you are a little runner girl, you're going to be biased towards programming running. So a long way of saying everyone thinks of bias as a bad thing. We are all biased. We're biased by our experience, our history. So as much as possible, I try to put my bias aside. My borrowers are free to do anything they want. And if they want to see the numbers for anything, 2 points, 3 points, you want to buy the rate down? Let's look at it. Let's run the numbers and you tell me. Here's what it generally comes down to. Let's say it generally wouldn't be this much savings, but if you could save 0.75% by paying 3 points, in general, let's say again, it's a $400,000 purchase. That's $12,000. When people see the monthly savings and they look at the $12,000, then they start saying to themselves, well, I was pretty sure rates aren't going to go lower and I'm not going to be able to refinance to that for free, but $12,000 is real money. Do I want to pay $12,000 for a lower interest rate, slightly lower monthly payment, or do I want to roll the dice? Look at a 2-1 buy down, a 1-0 buy down, and what those are. Those buy downs are actually setting money aside to subsidize the payment to pretend like we have a lower interest rate. Well, the only difference between doing that and points is the points are permanent. They're a sunk cost. You never get them back, but they're permanent. You're always going to get that lower monthly payment. So you're subsidizing your payment permanently. It's not necessarily a bad thing, but the numbers will never lie. You just have to run it for your situation and see what your thoughts are. So that's all I have for you guys this week. We will be back next week. Jeb will be in the house. He'll tell us all about hiking the Grand Canyon. He can go through all of that. But until then, adios, amigos.